Yeah, I'm a guy who started in New York City working on Madison Avenue, making $30,000 a year. I had to save up money for about 5 years, bought my first house, then bought my second, third, fourth, once I started getting promotions, and then decided to go larger.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. Hello and welcome to episode 82. If you're an avid listener to real estate investing podcasts, you've no doubt heard of today's guest. Joe Fairless is the host of the best ever real estate investing advice podcast, which is the world's longest running daily real estate podcast with over 1,000 episodes. Joe controls over $130 million worth of real estate, and he's the best-selling author of the best real estate investing advice ever, both volume 1 and volume 2, and he's raised over $50 million to syndicate apartment investment opportunities. And Joe has done all of this within the past 3 years. And today we're going to find out how he does it. Joe, welcome to the show.
Hey, thanks a lot. Looking forward to the conversation.
Yeah, thanks for being here. Now, I know you have a limited amount of time, so I'm going to just get right into it here. I gave you a very brief introduction. How would you like to expand on that?
Well, let's see who I am. I am a real estate entrepreneur. My primary focus is multifamily syndication. I buy apartment communities with investors and share in the profits together. And I work with the passive investors who are accredited. And let's see, I also, as you said, I got a podcast, world's longest running daily real estate investing podcast. I've interviewed Emmett Smith, who's a real estate investor, Barbara Corcoran, Robert Kiyosaki, Grant Cardone, and getting married later this month, and overall just enjoying life. Yeah, thanks a lot. And I was born in Flint, Michigan. I know you got a lot of Michigan listeners.
Yes, we are a Grand Rapids, Michigan-based podcast, but we talk to a lot of Michigan investors, and thrilled to have someone from Flint today. So yeah, and by the way, your show is fantastic. I'm a big fan of it. The best. Your name is even longer than the name of my podcast. The best ever real estate investing advice podcast.
It's a mouthful, I know.
But it says it all. So I'm just going to jump into it here, and frankly, I'm going to blatantly rip off your podcast for the first couple questions by just asking you, what is your best ever real estate deal?
I'd say the first deal I did with Ashcroft Capital when I first partnered up with my current business partner Frank, we bought a 250 unit in Houston, Texas at the time when, if you turned on the news, which I don't do, but if you did, then you would see that CNN and Fox and NBC and everyone else was saying, don't invest in oil areas, don't invest in Houston for sure. And they were wrong for a couple of reasons. One is oil did bounce back. This was in August of 2015. But then two, Houston is incredibly more diverse than what people think it is. Well, fast forward to today, we've had the property for a little under 2 years. We bought it for $14.1 million. We put in about $2 million, all in 16.1. And it appraised this past December for $21.6 million. And we have returned over 50%, to investors in less than 2 years.
Wow. So how long are you going to stay in that deal? Are you going to refinance, sell? What's your plan?
We refinanced in December. That's when it got the new
that's how you got
valuation. Yeah. Back. And we returned about 39% back on that refi, and overall, we returned over 50%. As far as the business plan for it, we have renovated all the 250 units, so that primary value add approach has been completed, and now we are focused on holding it for 2-3 more years, or if another offer comes up that makes a lot of sense, then we'll take a look at it. I mean, our number one goal in all of our deals is capital preservation. Number two is to hit the projected returns that we had initially with investors, which we've shattered or are on pace to shatter rather. And then three is to if we can exceed the return. So in that order of priority, we'll take a look at where we're at.
What were your initial projected returns?
I think it was. I don't have it in front of me the exact projected returns, but I would imagine it was probably 19% internal rate of return on a 5-year hold. And one thing we don't do is include the refi returns in our projections just to be more conservative. So at this point, I mean, we've returned over 50%, and investors have the same ownership level, still getting their preferred return. And so in other words, they're getting their preferred return on the original amount they invested, not the money that they still have into the deal. Yeah, exactly. Okay. Exactly. So the internal rate of return is 0 until you get all your money back. So, we have not hit the what we wanted to yet because we haven't sold the property, and that's a big windfall of cash whenever that happens.
Yeah. So what kind of financing do you have on it?
That one, we did a bridge loan initially. We've gotten away from bridge loans now. Just it's a little bit more conservative to go Fannie or Freddie and get more long-term financing. But then that one we did a bridge loan so that we could do the renovations and get the funding for our renovations for the property on a draw basis. So as we got certain renovations done, then we'd go check in with the lenders, say, hey, we got this renovation done, then they'd give us the reimbursements for what we spent on it.
Tell me a little bit about the property itself. What kind of tenants did you have? How would you classify it? B, C, A type property? It's
a B property. It's built in 2000. And interesting part about this property is it is right on the cusp on the inside of the school district lines where we're in a very good school district. Our neighbors down the street are not. And that's a huge difference in what we can charge for rent and who we attract. So as a result of being right on the cusp of a good school district, but then also being in a pretty affordable area, we're able to get premiums relative to the market immediately around us. The residents are maintenance men, school teachers. They are people who work in close by retail. There's a retail center that's about 10 years new or 10 years old that's close by. So it's the blue collar workers and people who work in the service industry in general, and then we've got a lot of families because of the school district.
So is this what you would call a value add type deal that you entered into?
Every deal we do is value add. So yeah, we always the type of properties we buy are stabilized properties that have value add components. Ideally, they were built between 1980 and 2003 or so. We don't want to do anything less than probably around $15 million. 15 to 40 million is probably our sweet spot for the acquisition price. We find that's a good area to be in based on our competitive set, who we're competing against for the deals. It's kind of in a tweener stage. You price out the local owners, and you're getting into the territory of hedge funds when you get to the $40 million mark, but you're still flying a little bit under the radar of the hedge funds where they don't want to cut a check for less than $20-25 million.
Wow. So repeat the numbers again. You bought this for somewhere in the 14 million range, and it recently appraised for over 25 million?
Yeah, 14.1, put in about 2, so all in about 16.1, and appraised for 21.6.
21.6. Okay. So what, going back to the value add component, how did you add so much value to this property in such a short amount of time?
Renovated every unit. And when we so the moment we close on a deal, and by the way, I commend you in your interviewing approach, because you are asking me questions that I haven't been asked. And so I appreciate that, just from keeping things fresh from my standpoint. I like talking about things that, I don't have unintentionally rehearsed in my head, because it's the same question I've been asked over and over. So thank you for that.
Well,
just as a side note.
Yeah, thank you. Yeah, you are somewhat ubiquitous, because I've heard you on so many other podcasts.
Yeah,
and your show, you share so much. So so I'm glad I'm getting to something new here.
Yes, you are. So as far as the deal and how we added value, so in a relatively short amount of time, I mean, we increased the rents at every apartment that we renovated, and now it's almost 24 months. We've renovated every single apartment that is at the property, and there's 250 of them. And I'd say, so that's one. Two is, the moment we take over the property, the moment we buy the property, we have our property management team outside the gates, and they're just chomping at the bit to take over management as soon as we give them the green light. And their immediate focus is on renovating the vacant units and leasing them out at our projected premium. So as soon as we take over, that's our main focus. In addition to doing any CapEx projects that the lender required us to do during the due diligence, or during the due diligence they required us to do after we closed. So those are our two main priorities from a construction side. And so we're able to start getting the premiums for those rents relatively quickly. It takes 3 to 5 days to renovate an apartment from start to finish, depending on what needs to be done.
And what kind of upside did you see in rents then once you did the renovations?
$150 premium on average. I mean, it depends on the unit size, but on average, we saw about $150.
Okay. And how much were you putting into each unit?
About $5,000.
Not a bad return on investment there.
Yep.
What's the average rent then?
I've got 9 properties.
So it's hard to know. Yeah.
Yeah, but I think around $750.
Okay, so you're looking at probably be like around a 20-25% increase in rent then.
Yep.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. I want to get to your growth here, because that was your first deal and it was a huge success. Since then, and I believe this has been in a 2-year period, you've acquired another altogether $130 million worth of real estate. How were you able to do that?
Partnerships, and I'll elaborate. It's actually now over 160. We closed on a deal this past Friday.
Wow, congratulations.
Yeah, and we're closing on another at the end of this month. So we'll be at around 175 by the end of this month. Partnerships, that's it. It's so there's a 3-step approach that I recommend your listeners take, and that I take when identifying how to scale your business and looking at a partnership. One is, and I'll get into specifics too, but just a 3-step approach. One is to know what skill sets are required to be successful in the industry that you're choosing to be in. And you identify those skill sets by listening to podcasts like yours and mine, and talking to local investors who are doing what you want to do, and learning how do they get to where they're at, and what skill sets did they use in order to get there. So then once you have all the skill sets identified that will set you up for success in what you've chosen to do, you need to look in the mirror and be honest with yourself and say, what are my skill sets from this list, and what are not my skill sets that are on this list. And once you identify what you can handle yourself, then you find a partner. And it doesn't have to be someone on the general partnership side. It could be simply a property management company that you hire and you pay a fee to. Or you could partner with a property management company. But the point is, you have to find the other team members who have an alignment of interest with you in the success of the project, and who complement your skill sets, so that you have all the skill sets that are required to be successful in your business. And then once you do that, then you, again, go talk to those people who are having success, and you say, okay, I've got the right team. Now, is there a certain next step that you think I should take, and try and get as much out of them as possible from how did they get to where they're at, and then simply model their approach, and you'll likely be able to replicate some of those results or even do better.
So, Joe, what would you say your skill set is? What do you bring to the table?
When I partnered with my business partner, Frank, it was clear to me that he had some skills that I did not have to his level, and still do not have at his level. And his skill sets are, he oversaw $500 million worth of apartment communities all over the country. He did that for about 7-8 years. He saw, he put together, he did the underwriting, he did the debt financing, he did the asset management, and he saw deals go full cycle. And he saw it through from start to finish. And so I knew, and I know, that there's no way that I can catch up to that type of experience, because he's been doing it for 7-8 years, and he's really, really exceptionally good at it. So my skill set in the business is I'm incredibly good at the macro level business plan and vision for not only our company, but each property. And then also making sure we have the money to fund the deals. So those are my primary responsibilities: the macro level vision and strategy for the company and each deal, as well as making sure that we have all the equity that's required to close. And his primary responsibilities are what I mentioned that he's good at.
Have you found that with your podcast and your listeners and just the way you've structured your company, that you do find it to be pretty easy to raise the equity for your deals?
I can virtually look you in the eye and say, easy. I don't know about easy is not the right word, but supremely confident that every deal will be funded. Yes. Mm-hmm. Because there's always conversations, and it's just, anytime you're raising money, it's just, you have one-off conversations multiple times, regardless of if they're returning investors. Sometimes returning investors don't have as many questions, or they usually don't, but have as many questions. But it's still not an easy process. But I'm supremely confident that we will fund every deal. I'd say a year ago, I wouldn't be able to answer that question the same way I just answered it. I've always funded every single deal that we've got under contract that we wanted to close. We've always got it done. But at this point, my business has reached a tipping point where we have more investors than deals, because we're getting, on the last deal we closed on this past Friday, 75% of investors are returning investors. And when you have that high degree of returning investors, then you're going to lower the amount of spots available for new investors. So, it's something that has not happened overnight, but it has happened in a relatively short amount of time. Now, the last thing I'll say about this, though, is it also depends on the equity raise. Because if it was a $100 million equity raise, then yeah, it's a hard. I don't know how I would do it, but I know I could make it happen. But it certainly wouldn't be having $50,000 conversations with investors. I'd have to go to a hedge fund or something like that. So I'd say any equity raise within probably up to $15 million, where we have to raise $15 million. Maybe even 20, then I'm supremely confident. Anything above 20 million on a deal, so around an $80 million purchase price or something, that's where I'd need to be incredibly resourceful.
Well, what's a typical minimum investment?
50,000. For the first, I have a minimum of 50,000 for a first-time investor with me, and then 25 thereafter. And Frank and I invest $100,000 of the company money, so our money, in every single deal alongside investors.
I want to talk about your marketing background. Really, I'd like to delve a little bit deeper into that, given the time that we have, into how your marketing experience has kind of translated and affected your success as a real estate investor.
Well, you're a marketer. I'm a marketer. Everyone who's listening who's an active real estate investor is a marketer. So we, at the very high level, regardless of if you do multifamily syndication or if you're buying your own stuff, you're matching up money with a deal. That's it. You find the money, you find the deal, you match it up, and then you oversee it successfully. And then, the wind's at our back as real estate investors. The longer we're in it, the more successful we'll be because of all the wonderful things that real estate encompasses. So from a marketing standpoint, my marketing background, it's everything. It allows me to know how to connect with investors, how to position my company, how to approach just the overall structure of not only our business but individual deals, because there are marketing programs we do with our residents that are inspired based on my marketing background. So specifically, 2 takeaways. One is I know from my marketing background that word of mouth referrals are the number one influencer of purchase intent. So because word of mouth referrals are the number one influencer of purchase intent, we have components built into Ashcroft Capital to generate more organic referrals from our investors to residents on our property specific basis, to incentivize them to encourage people they know to move into each of the communities. We have programs like reaching out to local businesses and getting an exclusive discount for our residents to shop there, like a local barbecue restaurant or something like that, and they have a loyalty card, and they just present the loyalty card. Hey, I'm a resident of XYZ apartment community. Here's my card, and bam, they get 10% off. And the local owners of these restaurants, they love it because they're able to get more business, and it's just 10% off, and we love it because it shows it gives us an exclusive angle for another reason why you want to keep living at the apartment community. That's just one small example.
That's great. That's a great creative way of generating interest in your apartments. And I want to talk about creativity quickly because that is a huge component of marketing, as you and I both know. And you've also performed stand-up comedy in New York City, which is a very creative thing to be doing. What was that experience like, and has that translated at all to your ability to speak with investors?
It was a horrifying experience. And yes, it has translated into something. I don't know what exactly, but it's part of what I've done. And the reason why I threw my hat in the ring for stand-up comedy. And by the way, I performed twice, and one of the comedy clubs is currently shut down. So that tells you how good I was. And that's a fact. I did improv first, and I did improv because I wanted to get better at public speaking in my job in advertising at the time. And they said, well, improv's okay, but the audience's expectation of you is much lower than stand-up comedy, because with improv, they know that you're seeing, this broomstick for the first time, and you have to make us laugh. But with stand-up comedy, they know that you've been practicing a certain routine, and you have to make us laugh every 7 seconds because you've been practicing, so you better make it funny. And so there's a lot less leeway. And therefore, I was like, all right, fine, I'm going to do stand-up comedy. And I took a class for like a month or two, and it ended with me performing at Gotham Comedy Club in New York City in the Chelsea area by Chelsea Market. And I did that. Horrifying experience, but I did it. I went okay. I didn't choke, but I don't think I was too funny because that's just not my nature. But I had a friendly crowd because I had a bunch of work friends there. So if you watch the video, there's a video somewhere. If you watch the video, it sounds like everyone's laughing, but I think it's just courtesy laughs.
Yeah, well, it's a great way to face your fears, and I'm sure that you must have drawn upon that experience in talking to investors after the fact.
Yeah, it's just my mentality. It's when I have something in front of me, then I just power right through it. Whether it's a workout or whether it's something like getting better at public speaking. If I want to get better at public speaking, I'm not going to just do improv because they said that that's not the most extreme thing. I'm going to do stand-up comedy. Why not? I'm going to just go ahead and sidestep the intermediary step, and I'm going to go straight to the end. And same with what I've approached with my business too. We've grown in two years to over almost $200 million worth of apartment communities. And it's because, I surround myself with the right people, the right partners. So I'm glad you asked about that. And we came out of the gate swinging.
Yeah. And by the way, you're a guy who started with 4 single family properties. Isn't that right?
Yeah. I'm a guy who started in New York City, moving from Texas to New York City, working on Madison Avenue, making $30,000 a year. And I living in the most dangerous area of New York City at the time, which was East Flatbush, Brooklyn. And then I had to save up money for about 5 years, bought my first house, then bought my second, third, fourth, once I started getting promotions, and then decided to go larger.
Yeah, great story. So we're at the end here. Why don't you tell us how people can get a hold of you or even listen to your show?
For everyone who wants a free multifamily resources guide, has a bunch of books, recommendations, and podcast recommendations, free websites to do market research, just email info@joefairless.com. That's info@joefairless.com. Mention where you heard about this from, and Samantha, my executive assistant, will get you that guide. So info@joefairless.com.
And once again, your podcast is the best ever real estate investing advice podcast. It's a daily show. It's 7 days a week. I don't know how you do it. I'm very impressed. But Joe, thank you so much for taking the time to talk with us today. And it's been a pleasure having you on the show. It
was a refreshing conversation. I appreciate your line of questions. You did approach it differently than anyone else who's interviewed me. So thanks a lot. Enjoyed it.
This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.